Hello and welcome to Erik Bank. My name is Jonas, I'm head of asset management. And I will try to briefly discuss what's happening in the summer, where we stand and what we're thinking and what we've done. I have tried to limit the number of slides, but I wasn't able to get it under 46. So I will try to speedily go through this because it's obviously a quite unique year, especially when you manage money based on data. First of all, with a global mandate, to be perfectly honest, just go straight to skip the chase here. I think there's a lot of pacifying language out there that we underweight equities, we overweight rates, whatever. From a global perspective, we have kept equities. The reason for that is that you lose as much money on rates as on equities this year. So if you look at a standardized Bloomberg index of 40-60 or 60-40, doesn't matter. You're down as much. What does matter this year is how you tactically trade on top of your strategic asset allocation, because your strategic building blocks are doing equally as bad, i.e. rates and equities. You could argue that we should have done more on alternatives, et cetera, and that's something there that we are scrutinizing ourselves, of course. But by utilizing FX exposures, vol hedging, short position spreads, et cetera, we've been able to limit the downside to less than half. And keeping a preparedness for an equity bounce, because we do not believe in a recession in 2022, and we believe in peak hawkishness, rebounding earnings, etc., as we discussed during the spring. That also means that from a strategic point of view, we're actually putting away from our competitors, even though we're overweight equities a year that are quite bearish for equities so far. Now, obviously, now we're in a bull market again in tech, but we'll come back to that. So it's a unique, a bit weird year in that sense, but also quite counterintuitively interesting to be bullish, i.e. the alternatives are bad or as equal as bad. And also, if you're able to survive in that environment and keeping your allocations intact and using overlays, they are quite easy to drop the overlays, as we did in June, early July, because when the equity bounce comes, you cannot afford to miss those bounces. Because in a year when you're down as much on rates and equities from a global perspective, global benchmarks, that is that's a really bad sentence to do, basically. So anyway, on a global equity perspective, we keep outperforming global equities, both on the very sustainable and still sustainable, a little bit less so portfolios. No news there. We have believed in peak hawkishness in terms of Federal Reserves back in March, peak priced inflation, peak yields. We believe that we have the risk reward on our side, i.e. there will be a rebound due to the fact that CPI and everything also obviously is going to peak. For us, it's been more of a challenge to keep cool in that sense, disregarding the media pressure from May, June, in waiting anticipation of the rebound. We do not believe in a recession in 2022 in the US. We have never done so, we still don't. And we see a rebound in earnings in Q2, and that has played out. So we think that a lot of our forecasts are playing out, and I think it's visible after June-July correction July-August correction that was the right case. The risks that we keep on checking is geopolitical risks. There are no geopolitical risks being traded so for the time being in the markets, i.e. we do not pay too much attention to this. We monitor it, but we don't put any risk on it. We do monitor the storage of natural gas. The inventory situation in Europe, as you have on the right-hand side, actually looks quite good. We do take note of the future prices on energy on the left-hand side in Europe. We keep a very low exposure to Eurozone equities as we've done throughout this year and actually for a couple of years now. We even lowered it during July-August rebound and increasing the money on the US in anticipation of that rebound. But that is something that we look at. We do look at media risk. We are sharply aware of the fact that today we are about 2.5 to 2.75% or times as nervous in media when media talk about the market compared to what the market is priced in. This could be horribly wrong for the markets, or media is horribly wrong. It used to be, when I started in this industry, that the market was always a bit more bearish than media, and then you had a blowout and then media reacted. And you became more nervous, you priced everything in terms of the great financial crisis, and then media woke up. But after Brexit and Trump, and maybe a bit of a clickbait economy, media is running the bearish scheme right now. For us, it's more a rhetorically interesting situation where we can keep a constructive and positive tone in the portfolios, but we know that we're quite alone in the sense of media. And obviously that's a situation that's quite easy to handle. It becomes a little bit more scary if media creates a self-fulfilling negative scenario, and I think that's why Moody's were out during the summer and said this is probably the first recession risk that we're talking about that's entirely created by discussion, not actual on-the-ground activity. That's their argument, but I think there's some validity to that. We also keep a look at U.S. political risk, which is turning around slowly, and that's constructive for the election. But obviously, the big risk for us is the CPI, and as we said, price inflation peak March. That was our headline for March. We have stuck to it. I.e., break-even is coming in lower and lower and lower and lower. We can model it towards headline, and we can see quite early. Yes, we would have a peak. Great, then we have to position for the peak. And as rates are doing equally as bad as equities, let's keep equities and be prepared to jump off all the hedges and everything, because the equities had to catch up to the underlying fixed income market. And that I think is what has happened during the summer. So this is nothing new here really for us. It's interesting though that the supply bottlenecks race that rolled over, i.e. back to transitory inflation and everything, then we rolled into the war. And now we sort of priced away the entire war premium and US break-evens and half of the supply bottlenecks as well. So is the Fed right in terms of transitory? I think the jury's still out on that. We do not sort of completely erase that idea, depending on how fast headline inflation will roll over. But if you look at the pressure for supply bottlenecks, they have been eating away on lower and lower and lower pressure for quite some time. Especially if you look at global supply chain pressure, that's historically very, very low. The last time there was this low was in 2008 when it collapsed quite rapidly. So we do not cancel out a quite sharp deceleration in inflation, which we quite enjoy because obviously we're heavily exposed to growth equities. Now, also do not remember, if you look at 1 year further out the curve, the expected change in inflation rate amongst US consumers is right now about 3.4%. We were up at about 8.5%, so we're more than halved in a couple of months or 6 months. Obviously, that's going to have some great traction on the headline inflation as well. And if you look at the break-even, although you combine them, all the curves, like 2, 5s, 5s, 10s, 10s, 20s, etc., then you can have a good grip on what the market is actually thinking in terms of headline inflation. And look at 4.5%. So both the market and the US consumer is more on the same page on where inflation will be during the autumn. Headline will probably react to that, and hopefully then equities, as I write here, will wake up and react to that as well, which is sort of what's been playing out during the summer. Before the Fed started hiking, it was clear that they're going to cut. We have to remember that. The fact that I notice sometimes in media that people are trying to make a case that, they're going to cut rates again, blah, blah. But we knew that even before they started hiking way back in last winter. So it's nothing new in that. And it's nothing new because the market realized from the very beginning that this is, I shouldn't use the word transitory, but it's less sticky inflation that we're dealing with this time around. Peak hawkishness was back in March, I would think, or argue in terms of Fed fund futures. And now we can see quite more sharply deceleration in rates. This obviously is also, given the fact what has been priced in equities, quite constructive for equities. So also, do not forget, if you use natural language processing, the Fed has turned dovish, and that is obviously quite important for us. In fact, after we saw this, the Fed meeting during the summer, there was a few days between the Fed meeting and the GDP. We actually increased equity allocation in between those a couple of days. The reason is this graph, where we can see that all of a sudden they turned quite dovish. They tried to backtrack some way, but at the end of the day, yields roll over. We all know they're going to be a bit more dovish. The big work on inflation is probably done. As such, the equity market is priced in way too much bearish news. Our headline yield model also turned lower, which was constructive for us. What also happened in the summer is they were quite elegant in the sense that they put out in the market how to quantify soft landing versus hard landing. So basically, we're looking at job openings to labor force to drop off while not pushing up the unemployment rate. So you want this to be as vertical as possible. They have managed that so far. The market rewards it and think, okay, cool, then we're in a soft landing camp. They got it under control. They're getting traction on that. We all know the benchmark or the barrier for a hard landing. We're not there yet. It doesn't look like we're going to be there quite yet. We can use SAM rules for that, for example. I'll come back and show that. But it's quite interesting. And then again, given what the market had priced in, we were ready for a rebound. So we've been overweight. It sounds more aggressive than it really is, given the fact that rates have been losing, as a matter of fact, exactly as much money if you look at our global benchmarks. So it sounds more aggressive than it really is, but we try to derive why we've been overweight. And first of all, our portfolio has been, when the blue bars are positive, it's been less volatile than the benchmarks. So i.e. we have been able to, during the June-July, to increase our equity exposure. We took that advantage because we thought the equity market was quite ready for a rebound. I'll come back to that. And it's been profitable so far, and we're going to keep that position for the time being. The reason why we like Chinese equities, as you can see, we have a lot more in Asia and Japan as well than Europe. And as a matter of fact, as of this morning, I think Japan is almost on the verge of erasing the drop this year, which is quite a stark conclusion given the fact of all the negative news that we have out there. But Chinese, they're increasing social financing, they're increasing their liquidity schemes, which should be constructive for equities going forward, which is why we keep on holding equities. Now, the equity sentiment in the US, we estimated to continue to pick up. Remember, we saw a clear trough in May. We were able to get ready because the dark green here is the Twitter sentiment. And it's more or less standardized now how to calculate Twitter sentiment for the equity market. Obviously, June drop in S&P 500 was sentiment was a bit painful, but we decided just to keep cool and keep our heads down and continue our strategy. And we've been rewarded since then, and we still think there's an upside for the equity sentiment. So we do not buy into this idea that the equity rally is disliked or the most hated equity rally out there, etc., etc. I mean, Twitter sentiment is on board, and you have institutions on board. So we think it was a bit more anticipated than perhaps it's given credit for. If you look at more traditional risk sentiments, so like rate spreads, CDSs, FX vol, fixed income vols, emerging markets, we're breaking through the benchmark. Clear sign for us to drop all the hedges and go max long, which we did. So far, it's been playing out quite well, and we're going to keep that position until we break lower again. If we keep on going higher, then we will come up to some way of utilizing this more. But it's obviously very, very cheerful, the fact that fear and greed is positive now for the fourth week this year. We have traditional risk monitors going on the upside. You have high lows, so advanced declines, bullish, bearish, and vol curve. Making a trough in June, again, that's where we started to change and become more risk active, and now getting good traction in the equity market. And if you look at this, you actually have a little bit of a plateau here almost. So the internal moves in the equity market has been quite constructive for quite some time. So it's not a surprise that the equity market turned around. I think it was a quite mature move after the blowout or blowdown in June that you're going to have this kind of rebound, which we think was very constructive. And what we know a year when rates and equities are doing or are struggling is the worst thing you can do is to miss the bounce in equity markets, because you're not going to get a second chance. So it's that's why we just couldn't afford to neglect these signals, which we didn't. The counterparty risk, dollar liquidity, vol curves did the same thing. Troughed in June, went on the upside, and we followed along. Institutions, in terms of smart money flow, they followed along as well. Who has then missed the equity rally? I would say retail investors have missed the equity rally. So we'll see what's going to happen if they come in from the sidelines. Obviously, for us already positioned, that's great news. But it's a bit of a shame, but it is what it is. Vol market managed to catch the trough as well. So we'll see what's going to happen there. We hang on to growth. We have a reflation trade indicator. Now you can argue and be quite and argue with us that, was it really worth hanging on growth, given that during this entire period it actually sort of lacked momentum versus value. For us, that was handled by doing easy stuff like keep growth, short S&P 500, isolate growth component, and you were able to not only keep up the global benchmark, but you were actually able to beat it. And then when you could easily drop the hedges and you can sort of let growth flex its muscles like we did in June, July. And then you have sort of also an attack bull market. Our idea here and why we've done that is if you look at the gap between the underlying positioning, which is just raw positioning data from commodities and rates versus the value versus growth, the gap was such big. So our thinking is that if we're going to have a catch-up, it's going to be like a catch-up bottle. It's going to be all at once. You're not going to have a chance to get into it or start reallocating. So it was easier for us just to do these overlying short positions and everything. Now you could probably done that a bit more clever, to be perfectly honest, and we constantly reevaluate and kick ourselves in that sense. Can we have done this a bit more optimized? But at the end of the day, we're very lucky that we hung on to growth. We're in the bull market, and with the overweight in equities as well. So why equities in the first place? Well, first of all, remember, equities have priced in a recession here now in the US. I just plotted here versus ISM. So we're going to have about 42.5 on ISM. We're not going to get 42.5 on ISM. If you price in this and you lose as much money or almost lose as much money on yields and rates and equities, our strategy is quite clear. Keep equities because it's obviously wrong. All you need is peak inflation, i.e. you're going to follow the break-evens in the US. So our strategic case was quite clear. It's easy to say now, then we get traction on it. It was a bit harder to perhaps argue for back in May, June, but you can look back at those videos. That's what we tried to do. Obviously, it's a lot more fun today, but we'll see how things evolve. So EPSs will fall. We already know that. It's already priced. It's not going to disturb the market. Now, interestingly, the earnings season surprised on the upside in Q2. We caught that in our model. And here you can see the result. It's very green. You even get rewarded in the equity market. And this is something that's going to stick with us into Q3 as well. So great quarter in terms of profits. It was predictable. And that sort of coincided this whole move versus the recession and everything. So why do we have a case for US recession in 2022? Despite all, we had 2 quarters of negative growth. Well, first of all, I think we should be a bit careful on how quarterly growth is calculated in the US. It's not quarter on quarter, and that's it, like we do in Sweden or in Europe. It's a bit more complex than that, which makes it they have a different definition of the recession. I'll come back to that. But first of all, in terms of now costing, US is clearly outperforming Europe. That's the first point. Then yes, we do see increasing recession risk in the US. It's will be a challenge in 2023, late 2023, early 2024. But here now, you have roughly 22% recession risk in the US. We can't base an allocation or something that's 25% risk or possibility. It's just way too low. So we can see it, but we can't see the risk for 2022, i.e. when the market has already priced it, you're done for a rebound. If you then stretch out and say, well, what do the yield curves say? Yes, you're going to have an increasing recession risk out here, but look at the time scale, you're back in way late 2023. Obviously, the Fed will cut rates before then, as we already know they will, because the whole inflation bubble was a bit of a bubble. So i.e. this signal will also, of course, shift. So if anything, it's a risk for like 12 months ahead or something. If you look at the risk for the next 12 months, given the Fed's own calculation of this in terms of credit risk, it's 23%. It's way too low to make sort of as a house view or base case or basis for your allocation. It's easier said now. We're still down on the year though. We're still struggling with that in the portfolios, but we think equities will actually close on the upside this year. So given what's been priced in. And also if you look at different states in the US, here you have all the states and I put them on top of each other so you can't really read this. It's a bit of a crappy graph in that sense. But the important thing is you can't see any state in the US in a contraction. If you build it, you can see slow momentum, but you're nowhere near traditional recessionary situation on a state level in the US. You were nowhere near on the labor market, so non-farm payrolls is way too strong. If you look at Sam Rule, she basically made this calculation. She works in the Fed, and like you have to have this clips of 0.5% unemployment steps. And you have to have that for an X amount of months before you reach a recession. It's a rule that has been 100% correct in 1958. One of the few, I think, that's been having that track record. Right now, 0%. I mean, you have no recession. And then you have our own high-frequency model clearly show that you still have positive growth in the US. And then obviously you have the most important one, that's the National Bureau of Economic Research and the definition of US recession, because they own the timing of US recessions. They build it on a number of data variables. We can look at those data variables and say, well, it's a bit tough to see recession here because they're still accelerating. If you actually look at the mean of them all, you're still in an improving environment. You're not even peaking. So it's very weird to come out with, we thought, with a recession case for 2022. If the market prices it in, and we can't really shift into rates because then it loses equal amount of money, but we can hedge on the equity side a lot cheaper and a lot easier. We can hedge our equity portfolios, and then we have to be very, very prudent to let go of this and let the risk free. Because if the market's going to catch up to this environment, then you have a lot of the correction to do on the upside. That was our strategy, and that is still our strategy, and that's why we dropped the hedges during July and starting in July, going to and June into July, and also into August. Obviously, we evaluate this every single day. If we're wrong, we're going to change it and become bearish, but we're not there quite yet. Now, we have also bought into the Nordics. There was a number of months ago. Remember that Sweden went into a negative GDP. That was sort of the trade of the last winter time. And now to trade sort of a little bit of a rebound, but also the traction of Swedish macro towards equities is quite low. Swedish equities are now trading more on US macro. But still, this is something quite positive from a GDP momentum. But also be careful here. This is run by the manufacturing side. The US consumer side in Sweden is a completely different ballgame. We have a real wage growth in Sweden, which is horrendously bad. We have a debt service ratio, which is all-time high. We completely miscalculated some big shifts in the Swedish economy. We like the manufacturing side. We like the linkage to the US economy. We have pulled down the FX exposure. We're keeping 55% unhedged versus the dollar. The rest is put in euro and a bit in NOK. And the reason for that is obviously the situation in Sweden. Now, with the Riksbank, we're able to hike rates in this environment. Our clear answer is to the extent what's being priced into the market today, no way. That's a trade for the rate market, but for us, it's quite easy to do on the FX side. Now, to end up with, try to stop or end on a positive note, global credit cycle, that can be calculated and defined in a number of ways. But you have the US credit impulse on the right-hand side. We can see what a great traction we get on commercial industrial loans and leases. You have a global credit we put against the current situation of World Centix as to see the kind of, do we get a traction or not? And both these readings are quite positive, which is great. We also want to raise a little bit of a warning of reading too much into this discussion of financial conditions. Remember that financial conditions can be calculated in almost 1,000 different ways. We have to define and calculate and adjust the calculation of financial conditions to suit our own portfolios. I'll show you our version next week. But I put in this bottom right-hand graph just to remind you that if you look at Fed from Kansas, St. Louis, and Chicago, you have three distinctly different views on financial conditions. And you can see this discrepancy here, which is quite big. So this is sort of a final note. With that, I'll end. I'll probably talked way too long, but I thank you so much for your attention. We'll be back in a week with an update. But so far, and what I guess is new from from before the summer is that nothing has really changed in the house view or base case. What has changed during the summer is that we have no longer any protections left in the equity market. We took all of them away, and we also used a little cash that we still had in our barn, so to speak. So now we're all in since mid-July, and so far we're getting good traction. We're going to keep that until we see something more negative materialize on the economic side or the financial side. But so far it seems that the market is waking up to the idea that, oh, by the way, the fixed income market has probably been right all along. CPI will roll over a bit faster than we thought. Even the US consumer argues that it's going to roll over a bit faster than it's been priced in on the nominal treasury curve, i.e. you're going to have a positive reaction, especially if you're already priced in a deep recession. So I'll leave you with that, and I thank you so much for your attention. I'll be back in a week. Thank you so much.